Well, good afternoon, everybody. My name is Lee Schwartz, and I'm the Director of Business Development here at SVA. I'd like to welcome you to our final webinar of 2024. This one's actually called Preparing for 2025, Your Guide to Year-End Tax Planning. Before we jump in here, I just want to take a few words, or take a few seconds and say a few words about SVA. Our vision is to remain independent, and our goal is to continue serving the same clients we have since we were founded in 1974. Closely held businesses, family-owned businesses, nonprofits, and high net worth individuals. And our mindset over these last now 50 years is that when you're a business owner or shareholder, your business is more than just a job. It's going to affect you personally. So it's important that your advisors are not just about compliance, but that they're working collaboratively with you in a consultative way. And that's our goal. This webinar and others like it are just one small way in which we do that. And as far as this webinar goes, please send in any questions you have as we go, but we're going to wait till the end to answer them. And let me get to our speakers. We have the best of the best for you today, and I am not just saying that because they're my bosses. We have Matt Vanderloo, who is not only a principal in our healthcare group, but is also SVA's CEO. And we have Eric Trost, a principal and really our top tax expert. Both Matt and Eric stay on top of tax strategies and changes happening on a local, state, federal level. So they're really the perfect two to talk about how best to plan for year end. So let's get comfortable on this wintry Wisconsin day and let us bask in the warmth of these exciting tax and legislative topics. Eric, I'm going to kick it off to you.
All right. Thank you, Lee. That was a very impressive intro, and look for a little something under the tree. We're going to start with the election that occurred, and the latest from Washington you see here. That election, I'm going to take a quick side note, did present a chance for a trivia question. And we're not going to have a contest. I'm just going to give you the answer. But the question is, Trump, assuming he does serve his second term here, will be the only, or will be the second president to be elected for 2 non-consecutive terms. Who was the first president that served 2 non-consecutive terms? The answer is Grover Cleveland. So feel free to use that at your cocktail and holiday parties coming up. So starting with the election, you recall last month, President Trump did emerge victorious, and also the House swung Republican, not by much. I believe there's 220 or 221 Republicans in the House now versus about 215 Democrats. So there's a slight advantage to the Republicans. And also the Senate swung Republican with 53 Republican senators now versus 47 Democratic senators. That's going to come into play later as we talk about what Trump's agenda may be and things he's talked about. There are, though, some expiring provisions coming up that started in 2017 and expire in 2025. The reason these are important and the current legislative makeup is important is because what's going to happen with these expiring provisions is going to be a function of what laws they pass probably by next summer. So some of the things that are expiring or set to expire in 2025 are provisions related to loss deductions and bonus depreciation. Bonus depreciation is the kind of depreciation where you can write off your business assets, and there's a couple different ways to do it, but bonus depreciation is one of them. So when you buy things for your practices or businesses, you can write those things off immediately and not have to take that deduction for the expenditure over time. The couple other things that expire that will be, I think, concerning that you'll want to pay attention to is the individual income tax rates. Prior to this Tax Cut and Jobs Act enacted in 2017 and expiring in 2025, the top individual income tax rates was 39.6%. And now the top individual tax rate is 37% with this new act, or with the act from 2017. So there's about a 2.6% differential between top rates. Those rates would be expiring at the end of 2025, meaning that the top rate would go back to 39.6% if nothing was done. The other big provision that's expiring is a taxpayer-friendly provision, and it has to do with the SALT cap. The SALT cap is the state and local tax cap. That cap, enacted in 2017, put a limit on state tax deductions of $10,000. So all of the taxes that you paid for your state income taxes and your property taxes, all those that were paid are limited to $10,000 as a deduction. And this was a pretty harsh cap, especially for individuals that were high wage earners, living outside of the zero tax states such as Texas and Florida. That SALT cap does expire at the end of 2025, meaning that there's going to be a full deduction again for state and local income taxes unless they do something to extend the SALT cap out. So looking forward, what do we think is going to happen with the new tax proposals that are going to be in place? Well, right now we have a lot to go on because Trump is not shy about putting out what he wants to do. And he tweets it and he truths it and he does other means of communication. He's not in office yet, but he's putting out his plans. And I think his fellow advocates and advisories are running step with him in putting out those plans. So some of the things that we expect to happen is that the bonus depreciation that's set to expire, we see that as coming back at 100%, meaning once again, that 2025 that was going to expire, we believe that's going to be reinstated and businesses will be able to write off 100% of assets that they buy for their business. We expect that the individual income tax rates are going to remain as high as 37%. They may be come down, but they are not going to go back up to 39.6%. We expect corporate income tax rate, which is at 21%. In certain situations, it might go down to even 15%. So there's going to be a revisitation going forward of what kind of entity should I be? A C corporation used to be a very high tax entity. Starting in 2017 with the Tax Cuts and Jobs Act, with the lowering of the corporate rate, it became kind of a medium tax entity. And if these cuts go through and you can get your entity to be a 15% tax rate as a C corporation, it's going to be some revisiting as to what kind of entity that you're going to practice your business in. A couple more things that we expect to see. Trump's been talking about tariffs and that being an income replacement for some of the income taxes that are currently being collected. So tariffs have already been threatened or suggested against our neighboring countries, Mexico and Canada, but also significant tariffs on imported goods from China. So to the extent those take place and raise revenues, I think Trump's looking for likewise rate cuts for individuals and businesses because the financial treasury will still have income coming through from those tariffs. So a couple other things that Trump has mentioned is even though the SALT cap is set to expire and would that be extended, Trump said he's going to eliminate the SALT cap or at least raise it. So instead of being $10,000 of deductions, which is allowed right now, perhaps that number is going to go up to 20, 40, or 80, or it's been talked about as to be eliminated. Trump's also looking to exempt certain income that's currently taxable. And that income includes Social Security, tips, and overtime pay. Should that happen, I think there's going to be quite a bit of rethinking on how employees are paid so that perhaps some employees will end up with tax-exempt income that's currently taxable. And one other item Trump brought in there is to have cryptocurrency exempt from tax, which could mean a lot for long-term cryptocurrency holders, and throwing in what used to be in the tax law, which was a deduction for auto loan interest. And that deduction hasn't been in the tax law since 1986. So that would be certainly a new thing for most of us to see. With that, I'm going to move this along to Matt Vanderloo, who's going to talk about tax planning and strategies for the upcoming year, or this year and next year.
Thanks, Eric. A great lead in there. Lots of fun potential changes coming down the pipe for us potentially, depending on which way the administration decides to go. But with all that change that potentially is coming, we're actually in a little bit more stable place than we might have been a year ago when there was even more uncertainty about whether the Jobs Act would be allowed to expire, what new administrations, when there were potentially two administrations, we had to weigh between what they might want to do and what the changes might come. So even with everything that might still be in flux, maybe in a little bit more solid place to make some plans here for the next few years. Whenever I talk about tax planning, I like to back up and have people think about this as a multi-year approach, not just planning for 2024 and what we can do in the next, 12 days before the end of the year, but taking a broader look at what's happening this year, next year, and the next couple of years, and look for changes or events that might be coming that might present an opportunity to do something a little bit different or a little bit outside of our normal operating pattern for someone to take advantage of those events, those opportunities to really do something fun, to the extent tax stuff can be fun, to do something fun from a tax perspective. Is there some sort of change in your employment? Maybe there's a retirement coming up over the next couple of years that is going to lead to a big drop in income several years out. So what can we do right now to take advantage of that and take advantage of those tax rates that right now with that Jobs Act still are pretty low if we look at a broader historical perspective? Or maybe there's the sale of a practice, the sale of a building, something else big like that coming up or happening this year, next year, the year after, that we want to take advantage of and do different things leading up to it or after it. The goal often being, what can we do around income and deductions, the timing of income and deductions, to try and smooth out our income over multiple years. Tax rates we have right now are low in a historical perspective. So if we can smooth out income, hoping that those income tax rates aren't going to change for the next several years, and manage ourselves into some of those lower rates and avoid any spikes in one year that are going to really jump us up into that top 37% tax bracket. And based on what Eric's saying, we think we've got a couple more years where this is probably going to get extended, a nice long period where we can have those lower rates. And this is much different advice than we were giving people just a year ago, when we were looking at the potential expiration of all these rates at the end of 2025. With those rates potentially expiring, we were looking at opportunities to accelerate income into the next couple of years and have that income taxed at a lower rate than it was going to get taxed at in 4 or 5 years from now. So a little bit more solid place now, with a strong likelihood, we think, of those low rates getting extended. So what are we looking at? On the business side, a couple great ideas, a couple big things we're looking at. We want to make sure on the business side, we're taking advantage of any opportunities that might be built into the entity structure that we're looking at. So on the healthcare side, most of the practices we see are structured as an S corporation, taxed as an S corporation these days. So that means we're looking at balancing what we're paying out those owners who are employed in the practice, balancing what they're getting paid as W-2 compensation, subject to income tax and payroll taxes, with what they're getting paid out as distributions, subject to income taxes, but not subject to payroll taxes. So what can we take advantage of there to try and avoid, reduce that payroll tax bill? And there's some traps we have to watch out for. The IRS wants to make sure we're paying reasonable comp to a professional working in a practice. So we can't go too low on the wage side. We also know that the wages we're paying ultimately impact and determine what any individual is going to get for a retirement plan contribution in a year. So we have to be careful about going too low on the wage side, but at the same time, we want to make sure we're doing everything we can to avoid the payroll taxes that come with that W-2 income. So looking to pay out more as distributions. Always trying to take advantage of the qualified business income deduction when we can. Remember, if you're a professional working in the healthcare space, that we've got some limitations based on your taxable income about whether or not you're going to qualify for that qualified business income deduction. And if you do qualify, we're limited based on the W-2 income paid out of the business, potentially, for how much of that deduction you can get. So really trying to pay attention year by year of where your taxable income is going to be, where the taxable income from the practice is going to be, and what we might be able to do if we're getting close to any of those break points where we might get phased out or eliminated out of that deduction. What can we do to stay under that and make sure we qualify for and maximize our potential deduction? Wisconsin entities, especially those are flow-through entities here in Wisconsin, those S Corps, LLCs, partnerships, we've been really leveraging the Wisconsin entity level deduction for our clients in a really positive way. And that's a way for us to avoid essentially that SALT cap on state income taxes. So we can make an election to have the entity pay the corporate tax, the Wisconsin tax that's due, instead of having it flow down to the individual's return and having the individual have to pay it. So a really powerful potential deduction there that we're leveraging in a lot of practices. So that's something we want to look at every year. And it's important at the end of the year to look, because we need to pay that Wisconsin tax in at the entity level potentially before the end of the year to avoid penalties. And then always considering retirement plan contributions, and are we getting enough into the retirement plan? It's a great way to get some taxable deductions, some tax deductions on the tax return, and also save for somebody's retirement. So always looking at what can we do there and are we doing enough? And the real great benefit here potentially is if you're a business that doesn't have a retirement plan in place, there are currently credits that you can take advantage of for putting a plan in place. So not only get the benefit of that retirement plan contribution, the tax deduction, the tax deferred growth on those dollars, but we can also get a credit that can help offset tax. Some other ideas that we hit on and we really like to take advantage of. If you have owners who are paying business related expenses personally, let's get those reimbursed by the business. Let's take personal expenses that you're paying out of your own checking account, move those up to the business level and get the tax deduction there. Real low hanging fruit, real easy thing to do. And there's a wide variety of expenses that we often see owners incurring that the business isn't paying. Make sure the business is paying for your cell phone if you're using it for work. If you're on the internet and on a personal computer at home at night doing charts, doing things related to the business, let's get some of that reimbursed by the business. Let's really take advantage of everything we can there. Mileage for continuing education expenses, make sure all of that's paid through the business. And if you've paid it personally, just have the business reimburse you. As we look at smoothing out income and expenses, remember one of the levers there we can really play with is the timing of when bills get paid around the end of the year. And can we either pay bills early if we're looking for more deductions this year? If we have enough in deductions and want to keep our income up, can we delay paying some of those bills into next year? The beginning of my career, we used to talk a lot about controlling the timing of receipts. But in medical practices, dental practices, now so much is paid electronically that we don't really have much ability to time when cash is going to get deposited into the bank. So we can't do much on the receipt side. So we really look at playing with the timing of bills. And then are there any equipment needs in the practice? If you know if you need something now, or you're going to need something in the beginning of 2025, making the purchase now at the end of 2024 and getting it in place and in use before the end of 24 would allow us to deduct it on the 24 return. So just waiting 30 days to make a purchase might delay your tax deduction by more than 365 days. So looking ahead a little bit, being a little bit more aggressive on those equipment purchases now and not waiting can be a great tax benefit. Usually it works well with the equipment suppliers too. Usually they're trying to meet their sales goals for the end of the year. So you can usually get a little bit better deal if you're doing it now. And then the other thing we look at a lot in practice situations is, do you have family members who are working in the practice? And if they are they getting paid? And are they getting paid a reasonable wage for what they're doing? It's a great way to generate some more deductions within the practice. And then if we're paying those family members, the dollars they're getting paid, are we leveraging those into the retirement plan at the office if they qualify? Or are we making IRA contributions or even Roth IRA contributions for those family members with those dollars? It can be a great saving strategy for any kids you might have employed. Pay them a reasonable wage for what they're doing, and then use those dollars to fund a Roth IRA for them. It's a great benefit, especially for kids where they're going to have a long time that those dollars can grow tax-free. On the individual side, looking to take advantage of retirement plan contributions within the business, but then if you've got any other outside business income, maybe you're doing rounding somewhere, you're writing articles, you're consulting somewhere else. There might be some other dollars that aren't reported through the business, but that we could still set up a retirement plan and leverage another retirement plan contribution for those dollars. We're always looking at ways to contribute to the Roth IRA. Isn't a great tax saving strategy today, but is a great tax saving strategy into the future. All the dollars that we can get into the Roth IRA are going to grow tax free for the rest of your life. There's no required minimum distribution on those Roth dollars, so they don't have to come out. So it's a great tax saving strategy in the future. A lot of our clients get income phased out of making a direct contribution to the Roth IRA, but with a little planning and a few extra steps, we can get to a Roth IRA contribution by contributing to a non-deductible IRA. So it's a great way to backdoor our Roth IRA contribution, a great strategy. Like I had said, we're in what are, they might not feel like it, but what are relatively low tax rates right now when we look back historically. So for some clients, we're really trying to take advantage of those low tax rates, and we're leveraging additional income and additional dollars into the next few years while we can enjoy those low rates. That might look like converting dollars from IRAs into Roth IRAs, which recognizes taxable income. That can be a great planning strategy. Or in the right situations, recognizing capital gains. Because if there isn't much other income, we can get those capital gains at really low rates, and sometimes even at a 0% federal rate. So a really powerful strategy there. With charitable contributions, two things we're looking at. Can we gift appreciated capital assets, stocks, bonds, mutual funds, whatever it might be? If we can gift those appreciated assets, we don't have to pay the tax on the capital gain, but we still get that high fair market value today as our charitable contribution. So a really powerful way to do it. And with the SALT cap, we've utilized a lot a donor advised fund. You can find these at any of the big investment houses, Schwab, Fidelity, whomever it might be. And it's a way for someone potentially to group multiple years of charitable contributions into 1 year, putting the money into the donor advised fund, and then sending the money out of the donor advised fund to the charities you want to support over time. So it can really leverage us into a really big itemized deduction in 1 year without disturbing the payment stream for the charities you're supporting. And then finally, on the Wisconsin side, really looking to leverage EdVest and the private school tuition deduction on the Wisconsin return to give people some advantage for college costs they're paying for kids or private school tuition they're paying. Most of the federal college type credits our clients are phased out of from an income perspective. So using EdVest and getting that Wisconsin deduction or the private school tuition deduction are the best we can do. And one of the powerful things we do is look and work those two credits deductions together. So maximizing what we get for a Wisconsin private school deduction every year, and then any tuition over that maximum for that deduction, running through EdVest to get a deduction that way. So it's part of the strategies we're using, but some really great and really powerful ones. And there's still time on a lot of these to take advantage of them here before the end of the year or even into next year to fund some of those EdVest dollars. I'm going to turn things back over to Eric for a couple minutes for one last tax update on one of our favorite new topics, CTA and BOI reporting.
Thanks, Matt. Matt, as my kids would say, that sweater you're wearing, that eats. I think that's how they say it. Corporate Transparency Act. This essentially is an act that was enacted some time ago, but now has a pending due date here of December 31st. And what it's really looking for is asking for a report of owners of businesses that are, we'll call small businesses with under 5 million in sales. And the idea behind this is for law enforcement agencies to have a one place go to get to what entities are owned by what people. So that's their stated purpose and cause to get this. Now, what's happened in the last 2 weeks is that there have been many business groups fighting this. And a business group down in Texas has been successful with a judge who said that this rule is just not constitutional. Asking for all this information is not constitutional within the framework of the agencies that are asking for it, in this case being FinCEN. And so that judge put an injunction on this filing, which means that these Corporate Transparency Act forms are not due by December 31st. There is no due date for them. And in fact, the FinCEN website now where you file these forms say this is a voluntary filing. Having said that, The government, of course, is appealing this decision and trying to get this decision reversed in the Fifth Circuit. And they are right now looking for an emergency appeal to say that this decision is going to be at least put on hold until it can be decided, meaning that this due date and these forms now are back in play, and that the due date currently, as it stands at 12/31, would be reinstated. To throw a little more spice in, Congress has drafted a bill, which is not yet passed, that says these Corporate Transparency Act forms are due a year from 12/31/25 or 12/24, which is coming up here. So they're due at the end of next year, not at the end of this year. So what do you take from this? Bottom line, I think you have to be ready to file. If you don't want to voluntarily file, you don't have to. But I think you want to be ready to file these forms if we can get those forms at least prepared or ready, but not filed by the end of the year. And just watch for what's going to happen with this, with these latest. The reason you don't want to miss the filing is because if it's late, it gets expensive. It gets up to $500 a day. There's a $10,000 non-compliance penalty. So there are significant costs that go along with not filing these forms. If you have not talked to your attorney or accountant about this, you should talk to them before the end of the year. Just make sure you're ready to go in case you have to file them. It's a relatively easy file, but you don't want to miss it. I'm going to turn it back over to Lee to close us up.
All right, thank you, Eric and Matt. Lots of great information. So we've already had a few questions come in. Please send in. We're going to take a few minutes here and answer those. And if you have any additional ones, please send them in the chat function now. Let me just bring that up, you guys. So first question that came in was, all right, I guess, Eric, you might have to put on your prognosticator hat here, but the question is, when does tax legislation typically pass in a new administration? Is it at the beginning? And when do you think it would be effective?
Yeah, I think what's going to happen is it's going to be similar to when other presidents came in and had the House and Senate. So Clinton, when he came in and had the House and Senate, he passed all his legislation in August of '93. The last time Trump was in 16, and he had the House and Senate, he passed his tax legislation in September of 17. So I would expect by the fall, they have some of these things worked out, and sometime in the August-September timeframe, they're going to have a new bill drafted and be looking to pass it. And I fully expect something to pass now, because all these expiring provisions have really forced their hand. And so I expect something to pass for sure, and well before the end of the year.
And Eric, when that passes, if that's August, September, October, whatever it is that typically effective for that tax year, or does it start in the following year?
Yeah, the answer is yes. There's going to be different provisions that are going to be effective for the current tax year, 2025, and there'll be provisions that they kick to 2026. And then there's actually some provisions that they may pass and say effective today. So, for example, when Trump passed his Tax Cuts and Jobs Act in 17, bonus depreciation and the changes to bonus depreciation were effective on the day that legislation passed, even though it was like right in the middle of September.
Okay, so to be determined. We'll see. I think it sounds like you guys are going to be drafted to do more webinars when that time comes. All right, next question was, what are the, and I think, Matt, you mentioned this, so what are the credits for putting a retirement plan in place, and when would those take effect?
There are a couple of credits that relate to, and there's a calculation that's a lesser of this, greater of that, to determine what your credit is. And it's based on the costs you incur to put the plan in place, the number of employees covered by the plan. And ultimately the cap is at $5,000. You can't get a credit of more than $5,000 for putting the plan in place. And the credit's going to flow through in the year that the plan gets put in place. So if, we might be getting probably a little late to get anything done here in 2024 if you don't have a plan in place already. But now is the perfect time to start thinking about, if you don't have a plan in your practice, your business, what do you want to do for 2025? Because now you've got a nice long runway to work with the different advisors you're going to talk to, your CPA, a retirement plan administrator, maybe your attorney, to figure out what the right retirement plan for your business is going to be and what that's going to look like, effectively communicate it to your employees and have it up and ready to go before the end of 2025.
Great. And I'll put in a plug for one of our past webinars, trying to think maybe September, October, we did a half an hour session on retirement plans in your practice. So they're certainly dive in more there, and those are recorded. You can download those as well. Last question we had was, how can I minimize taxes when transitioning my practice to an associate?
We should probably do a whole webinar on just that question, because we're not gonna get into all of it right now. But the first overall key I'd say there is that there's a lot of strategies that we can put in place to try and minimize what you have to pay in tax in a transition like that. And the key to taking advantage to all that is to start planning as soon as we can on what that transition is going to look like. Because by the time you get to the end and the deal is done, a lot of the work that's been done is going to box you in from a tax perspective. And from a tax perspective, we want to get involved early on in that process and help with discussions around not just what the sales price is going to be for the practice, but how that sales price is going to get divvied up between the different things that are being sold within the practice. Or if you're actually just selling the stock in that entity to sell the practice, that's going to impact a lot what that looks like. And then there are other things other levers we can pull and dials we can turn about when the payments come in, if the payments get spread out over multiple tax years, and what that looks like to really try and impact in a positive way how much tax you're paying on that transaction.
Okay, you guys, great information. Matt and Eric, thank you as always. As we wrap up here, just want to point out to all of our listeners, you can go to svaccountants.com to sign up for tax alerts and biz tips. There's a lot of other resources there to help you, including some of those webinars that we've done as well. So check out those. And keep in mind, the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. And if you're not an SVA client, please contact me or anybody in our business development group, and we can get you the help or the answers that you need. Thanks again to Matt and Eric, and to all of you for attending today. Hope you have a wonderful rest of your day and a great holiday season. Take care.